ACOMO N.V, ACOMO, traded on the Euronext Amsterdam exchange, is analyzed as an integrated specialist within the global food and beverage ingredient supply chain. The company serves as a holding entity for an international group of businesses involved in the sourcing, processing, trading, packaging, and distribution of both conventional and organic food ingredients. The central investment thesis for ACOMO hinges on its proven ability to convert thin commodity trading margins into superior operational profits through structural efficiency, coupled with a defined, M&A-supported strategic pathway towards significant margin expansion. The operational results for the first half of 2025, H1 2025, confirm a robust trajectory, achieving record performance and validating management's strategic direction. The company's mid-term financial targets, presented at the April 2025 Capital Markets Day (CMD), project substantial growth in scale and profitability, positioning ACOMO as a resilient, specialized player in a supply-constrained environment. Based on the strong momentum, the high degree of operational efficiency, and the achievable nature of the mid-term profitability goals, a normalized valuation indicates the equity holds significant potential. The primary financial concern remains the volatility of free cash flow, FCF, which has been subject to significant working capital drag in the last fiscal year, obscuring the company's underlying earnings quality. Investment recommendation: overweight. Key investment drivers: superior operational efficiency. ACOMO maintains exceptional control over operating expenses, demonstrated by its top-tier operating margin, which outperforms over 95% of industry peers. 3. This efficiency provides critical operational leverage. Validated strategic trajectory. The achieved increase in the TTM EBITDA margin to 7.62% as of June 2025 already substantially closes the gap toward the midterm target of C9%. M&A and scale. Strategic acquisitions such as Caldic and Manuzzi 6 enhance scale, diversify product offerings, and provide the synergy potential necessary to meet the $2 billion sales target. Primary investment risks. Working capital volatility. Fluctuations in commodity prices necessitate increased capital absorption to finance inventory, causing volatility in cash conversion and distorting the price-free cash flow multiple. Commodity price exposure. Specific input price instability, e.g. cocoa market circumstances, negatively impacts group results, emphasizing the critical reliance on effective hedging strategies. Integration risk. The successful realization of the 9% EBITDA target is contingent upon the flawless and rapid integration of recent acquisitions to capture projected synergies. IV. Corporate profile, business model, and segmentation. 2.1. The integrated business model and value chain position. ACOMO N.V, formerly Amsterdam Commodities N.V, is a Rotterdam-based holding company founded in 1908. 9. Its core competency is managing the complex supply chain for specialty agricultural commodities and food ingredients, bridging the gap between producers and the global food and beverage industry. 1. The business model is highly integrated, encompassing the full value chain: sourcing, processing, trading, packaging, and distribution. 9. This structure allows ACOMO to offer sophisticated food ingredients and solutions rather than merely acting as a bulk commodity trader. By controlling multiple steps in the process, the company mitigates supply chain risks and ensures measurable impact and stable supply for its customers. 5. This downstream focus is critical, as it shifts the revenue model towards value-added services, justifying the significant operational leverage the company exhibits. 2.2. Segmental deep dive and revenue concentration. ACOMO organizes its operations into 5 distinct segments, reflecting its diversified yet specialized focus: spices and nuts, edible seeds, tea, food solution, and organic ingredients. 1. The spices and nuts segment is the key revenue generator for the group. 1. This segment, represented by companies like Katz International BV and King Nuts BV, focuses on sourcing and distributing tropical products, including pepper, nutmeg, desiccated coconut, shelled nuts, dried fruits, and snack items. 9. Given its revenue dominance, the group's overall performance is highly sensitive to price and volume dynamics within these specific agricultural markets. The recent acquisition of the Italian nuts and dried fruits business Manuzzi and the Chaldic nuts and dried fruit business further solidifies its market position in this core segment. 6. The edible seeds segment deals in high-demand ingredients such as poppy, sesame, pumpkin, and sunflower seeds, catering to the snack, retail, bakery, and confectionery industries. 9. The Organic Ingredients Division, Trade and Organic, and Food Solutions segment, SNCC Euro Ingredients N.V, are strategically important for long-term margin expansion. 9. The Food Solutions segment is particularly focused on producing and supplying culinary and functional ingredients, plant-based solutions, and customized wet and dry blends, coupled with services like product development and inventory management. 9. This movement into proprietary ingredients and customer-specific solutions represents a calculated shift away from lower-margin bulk trading. This strategic realignment is essential for achieving the ambitious C9% EBITDA margin target. By capturing margin downstream through processing and formulation services, ACOMO structurally improves its overall profitability profile, compensating for the inherently low gross margins associated with raw agricultural trading. The company operates internationally, primarily focusing on the Netherlands, other European countries, and North America. 9. IV, Macroeconomic Environment and Operational Risk Assessment. 3.1. Industry Positioning and Competitive Advantages. ACOMO is positioned in the consumer staples sector, specifically within the packaged food and distribution/wholesale industry. 2. Its longevity, founded in 1908, and status as a publicly held corporation provides the scale, stable financing, and established supply chain relationships required to operate effectively in volatile commodity markets. 9. A key competitive advantage lies in the company's ability to maximize efficiency post-sourcing. While the gross margin of 14.47% places it in the lower half of the industry, underperforming 76.19% of peers. 3. Its operational margin of 5.85% is superior, outperforming 95.24% of the industry. 3. This structural efficiency confirms that ACOMO's value creation is not derived from initial markup on raw commodities, but from excellent operational execution, logistical control, and stringent cost management in its processing and distribution networks. This focus on execution makes the operational efficiency highly scalable as the company pursues the $2 billion sales target. 3.2. Commodity price volatility, the core risk. The dependence of ACOMO's core segments on agricultural inputs exposes the group to significant commodity price risk. Globally, this risk is escalating, ranking 6th in 2025 and forecasted to climb to 4th by 2028 due to geopolitical tensions and climate disruption affecting supply chains. 13. This vulnerability was evident in the H124 results, where cocoa market circumstances were noted to have negatively impacted group results. 8. Commodity price instability not only threatens the realization of stable trading margins, but also has a pronounced effect on the company's working capital requirements. When prices rise rapidly, more capital is absorbed to finance the same volume of inventory, placing a significant drain on operational cash flow, discussed in Section V. 3.3. Hedging and risk mitigation strategies. To maintain the ambitious profitability targets and secure stable supply, ACOMO must deploy rigorous risk mitigation measures. Commodity hedging is a popular and important method for reducing risk in sensitive agricultural markets. 14. Hedging typically involves using derivative contracts to lock in prices for vital commodities, ensuring that a consumer, like ACOMO, can reliably purchase materials at a predetermined cost, thereby protecting future margins. 14. The sustained achievement of the midterm 9% EBITDA target is directly reliant on the efficacy of these hedging strategies. These financial measures are crucial for decoupling operational margins from volatile market swings, providing the predictable earnings stream required to support growth investments and the high dividend payout policy. Financial performance and profitability trajectory. 4.1. Revenue growth and recent momentum. ACOMO has demonstrated robust top-line growth. For the full fiscal year 2024, FY 2024, the company reported revenue of €1,362.82 million, representing a 7.64% growth rate. This momentum accelerated significantly in 2025. Sales improved by 16% in the first quarter of 2025. 7. The most recent reported figures spanning the trailing 12 months, TTM, ending June 30, 2025, highlight substantial scale-up, with TTM revenue reaching €1,453.07 million, reflecting an annualized growth rate of 14.75%. 4. This performance suggests that strategic initiatives, including M&A and organic expansion in core segments like spices and nuts, are generating tangible commercial benefits. 4.2. Margin quality analysis. The quality of ACOMO's earnings is characterized by a structural disparity between low gross margins and superior operating margins. The gross margin for FY 2024 was 14.47%. However, the company's meticulous control over operational expenses results in an operating margin of 5.85% and a net profit margin of 3.32%. These profitability metrics place the company in the 95th percentile relative to its industry peers, confirming its status as one of the most operationally efficient companies in the specialized ingredients distribution sector. This scalable efficiency is the central driver of long-term value creation. Crucially, the EBITDA margin has shown a clear positive trajectory, moving from 6.48% in FY 2024 to 7.62% in the TTM period ending June 30, 2025. 4. This demonstrable improvement, achieved through record H1 2025 performance, $68 million adjusted EBITDA, 7, provides strong validation that the strategic pathway outlined by management is yielding immediate results. 4.3. Profitability and return ratios. ACOMO maintains solid returns on invested capital. Its return on assets, ROA, stands at 5.21%, which is better than 71.43% of industry peers. The return on equity, ROE, of 10.33% is broadly in line with the industry average. The respectable ROA suggests the company is effectively utilizing its tangible asset base, typical for a distribution and processing business, although the capital intensity of financing volatile inventory levels requires careful management to prevent efficiency deterioration. Strategy, Growth Drivers, and Management Targets, CMD 2025 Review. 5.1. Strategic CMD Objectives. At its Capital Markets Day, CMD, on April 7, 2025, ACOMO presented its medium-term strategy focused on securing superior, sustainable growth and accelerating long-term value creation. This strategy is underpinned by 4 specific, aggressive financial objectives. Sales target, €2 billion. EBITDA margin target, C, 9%. Balance sheet target, debt/EBITDA less than 2.5. Shareholder return target, dividend payout greater than 70%. These targets represent a clear ambition to scale the business significantly while improving operational returns and maintaining financial discipline. 5.2. Growth Pathway and M&A Integration. The growth pathway relies on both organic expansion and strategic M&A activities. Recent corporate activity indicates a focus on strengthening the core spices and nuts segment and expanding geographic reach, exemplified by the closing of the acquisition of the Caldic nuts and dried fruits business in late 2024 and the acquisition of the Italian nuts and dried fruits business, Manuzzi. The most demanding target is the EBITDA margin expansion from the current TTM 7.62% to the C 9% goal, a jump of approximately 140 basis points. The successful realization of this margin improvement is heavily dependent on the swift and comprehensive integration of these acquired assets. Failure to quickly realize cost and revenue synergies from the Caldic and Manuzzi businesses could significantly delay or inhibit the achievement of the 9% target. However, the demonstrated TTM margin improvement from 6.48 FY 2024 to 7.62% suggests management has successfully initiated the margin improvement process, reducing the remaining execution risk. 5.3. Financial leverage and balance sheet management. The company emphasizes maintaining a strong and resilient balance sheet, especially critical given the high capital requirements of agricultural commodity trading. The target debt/EBITDA ratio of less than 2.5 provides a clear benchmark for leverage. Achieving this target while simultaneously financing the required increases in working capital due to higher sales volume and commodity prices will be a critical measure of management's capital allocation skill. Support for this objective includes the extension of the existing revolving credit facility, which provides enhanced liquidity and financial flexibility necessary to navigate market changes and fund the group's growth and working capital needs. 6. Capital structure, cash flow, and dividend sustainability. 6.1. Working capital cycle and cash flow volatility. Despite achieving higher net income, $60.6 million in 2024, ACOMO's cash from operating activities, CFO, showed profound volatility in 2024, plummeting to $30.7 million from a strong $137 million in 2023. This severe cash flow reduction was almost entirely attributable to a significant negative change in working capital, WC, which registered minus $76.1 million in 2024, a change of over $120 million year over year. This dynamic is typical of businesses engaged in commodity trading during periods of rising input costs or rapid volume expansion. In this scenario, the company must commit significantly more cash to finance the higher value of its inventory and manage its accounts receivable cycle. Therefore, the profitability metrics, EBITDA, net income, must be viewed with caution until the volatility in working capital stabilizes and normalizes FCF conversion. Free cash flow, FCF, and valuation discrepancy. ACOMO exhibits a low fixed capital intensity, with capital expenditures, CapEx, remaining stable and low, approximately $7 to $8 million annually. This low maintenance reinvestment requirement should, under normal circumstances, translate to a high conversion rate of net income into free cash flow. However, the significant working capital drain in 2024 has led to a highly distorted valuation multiple, with a price/free cash flow ratio of 30.89x. This high figure suggests the stock is expensive based on recent cash generation. The investment opportunity relies on the premise that the negative working capital fluctuation is cyclical rather than structural. A return to a neutral or positive working capital cycle in 2025 and beyond would dramatically improve FCF conversion. If FCF were to normalize to a level commensurate with its high net income, the P to FCF multiple could drop significantly toward the industry average, likely 15 to 20, triggering a substantial positive repricing of the stock. Therefore, FCF normalization represents a powerful impending catalyst. 6.3. Dividend policy and cash coverage. ACOMO maintains a consistent dividend policy, aiming to pay out a substantial share of its annual net profit in cash, subject to FCF realization and solvency. The midterm financial objective explicitly sets a high dividend payout ratio target of greater than 70%. This commitment to high shareholder returns is robust only if operating cash flow returns to its normalized levels, that is, matching or exceeding the high CFO in 2023. If the working capital drag persists, the company will be compelled to utilize debt or existing cash reserves to meet the dividend target. Sustained reliance on external funding for the dividend would inevitably strain the balance sheet and challenge the achievement of the debt/EBITDA target of less than 2.5. Consequently, the sustainability of the dividend is intrinsically tied to effective working capital management. 7. Valuation and peer benchmarking. 7.1. Current market metrics. As of July 2025, ACOMO is trading near its 52-week high, with prices ranging from 23.65 to 23.90 euros. The stock's 52-week range, 16.98 to 25.15, reflects strong market recognition of the company's recent record financial performance reported in H1 2025. The market capitalization stands at approximately 700 million to 732 million euros. 7.2. Relative Valuation Multiples FY 2024 data. The current valuation exhibits a significant discrepancy across cash flow and earnings multiples. Enterprise value to EBITDA, EV/EBITDA, the ratio of 8.48x is moderate for the sector. This multiple suggests the market prices ACOMO reasonably based on its current core operating profitability. If management successfully executes the strategic plan and achieves the 9% EBITDA margin target, the denominator, EBITDA, will increase, resulting in a significantly lower and therefore more attractive forward EV/EBITDA multiple. Price/free cash flow, P/FCF. The ratio of 30.89x is expensive, valuing ACOMO more expensively than 61.90% of its industry peers. As established, this multiple is severely inflated by the temporary cyclical working capital drain experienced in 2024. 7.3. Peer benchmarking conclusion. The contradictory valuation signals, an average EV/EBITDA ratio juxtaposed with an expensive P/FCF ratio, reveal the core market debate surrounding ACOMO. Investors acknowledge the company's exceptional efficiency, operating margin in the 95th percentile, and its stable operating income, which supports the EV/EBITDA valuation. However, the market remains cautious regarding the consistency and quality of cash conversion reflected in the high P/FCF. The analysis concludes that ACOMO is undervalued on a normalized cash flow basis. The stock is currently priced as a moderate operating entity, 8.48x EV/EBITDA, that experiences highly volatile cash flows. Should the working capital cycle normalize, the resulting improvement in FCF conversion will align cash-based multiples with earnings-based multiples, unlocking significant shareholder value. Conclusion. ACOMO N.V. is a specialized, highly efficient food ingredient solutions provider demonstrating clear commercial momentum and a validated path toward higher profitability. The company has successfully navigated the challenging commodity environment of 2024 to deliver higher net income and achieve a substantial increase in its TTM EBITDA margin, 7.62% in the first half of 2025. This success provides powerful evidence that the strategic ambition to achieve C.9% EBITDA margin is plausible through scale, segment mix shift toward food solutions, and integration synergies. The group's core structural strength lies in its ability to generate high profitability, top 5% for operating margin, despite operating in a low gross margin environment, indicating exceptional operational leverage that should accelerate earnings as the $2 billion sales target is approached. The prevailing FCF volatility, driven by cyclical working capital requirements, is viewed as a temporary constraint rather than a structural flaw in the business model. This volatility presents a near-term entry opportunity as the stock is priced at an attractive EV/EBITDA multiple, which will become significantly cheaper as the 9% EBITDA target is achieved. The overweight recommendation is based on the strong H1 2025 results and the expectation that FCF will normalize in the subsequent reporting periods, closing the gap between the high net income and the currently depressed cash from operations. The company is poised for value realization as its balance sheet efficiency improves. Key monitoring points for institutional investors. Working capital stabilization. Investors must rigorously track the changes in working capital line item in subsequent cash flow statements. A return to neutral or positive working capital generation is required to normalize FCF conversion, which is the necessary catalyst for justifying a lower P/FCF multiple and releasing accumulated operational cash. M&A integration success. Ongoing performance reports should detail the successful integration and synergy realization from the Caldic and Manuzzi acquisitions. The transition from the current 7.62% TTM EBITDA margin to the 9% target serves as the ultimate barometer of successful M&A execution and organic margin expansion. Hedging effectiveness. Given the sustained and projected rise in global commodity price risk 13, investors should seek assurance regarding the effectiveness and scope of ACOMO's commodity hedging strategies. Stability in gross margin is a direct indicator of successful risk mitigation against input price volatility, particularly in sensitive markets such as cocoa. Debt management. While the debt/EBITDA target of less than 2.5 is sound, any persistent negative working capital trends that require increased borrowing to finance the high, greater than 70% dividend payout ratio must be carefully scrutinized, as this would stress the intended financial resilience of the balance sheet.